Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell. I'm back in the Bahamas with my good friend David Skarica. He has the website addictedtoprofits.net. Before we get started, we have a book giveaway that we started last week when we interviewed Jordan Roy Byrne at the Daily Gold. We're going to leave that up for one more week. All you have to do is visit palisaderadio.com. There's a web form at the top. Just plug your name in there, and you'll get the book sent directly to you. Thanks again to Jordan for that. David, welcome back to the show.
Thanks for having me.
You know, we were talking about this guy, Bill Fleckenstein, who's a guy that you know. He runs a group called Fleckenstein Capital, and he's a short guy. He's on the short side of the market. We were watching an interview the other day, and it brought up a theme that we've been discussing. He said things might be crazy right now, but then they get crazier. And I want to use that to talk about the market today. And also, we're going to later on in the interview talk about gold and gold stocks and how that theme can play out.
Yeah, thanks for, well, what we want to talk about is that we had this big bubble in the last 6 years in the stock market. And, you know, I wrote a book last year called Collapse, and I'm doing a follow-up book called Bear Market Rising. And I'm talking about, you know, why this was a bubble, why the valuations hit extreme. But what always happens in these bubbles, they go further than you think they would. Like, for example, in 99, 2000, the NASDAQ, after going up for years, doubled in the last 6 months of its trading. We had dot-com stocks that had no hope of ever becoming a viable business, you know, trading at billions and billions of dollars, if not tens of billions of dollars in market cap. And then, of course, in housing, we had I remember having a Haitian cab driver in Miami in 2005 tell me that his $60,000 house, which he bought for, is now worth $150,000. And of course, all these collateralized loans and you know, just absolute insanity going on there. And then, of course, now we've had again this kind of stock market bubble, which has kind of had also another .com and technology type bubble. An example of the crazier getting crazier is one of the stocks that where I've done quite well on my short, especially in the last 6 months, one of the stocks that I've tried to short via put options and haven't done so well on is Netflix, which I thought topped out last year, adjusted for split, at about $480. So actually pre-split, which would have been about $70 for its split. And it's like $100 now, went up to almost $130 and trades at like 8-9 times revenues. So that is just like how insane that the market can get on the way up. And that's just like just a real lesson of how these bubbles work and how markets work. And a lot of the stocks that I'm short now weren't even on my radar last year, because even though I turned bearish in the middle of last year, like these stocks after the October low of 2014 all began to go parabolic or straight up or turn into bubbles really from, you know, that October into this spring and summer. So it, again, and some of them are up, you know, 300, 400, 500% just from that period. So again, things usually go further than you think. But by the way, they also can go further than they think on the downside, as we've seen in the gold stocks, that when this bubble bursts, many of these stocks are going to go down 80, 90, 95%. And people are going to be shocked at how some of these so-called quote-unquote leaders, you know, basically go down 90, 95, 99%. Like, for example, that happened in companies like Amazon.com and Priceline.com back in the 2000 bubble.
Yeah, and it's interesting that you talk about gold, because I think the mantra of things can get even crazier applies to gold right now. Whether you subscribe to the manipulation theory or just the gold's corrected for a few years because it did go up for 12 years, people are surprised that gold's sitting and bouncing around this spot. It's got a nice base forming, but a lot of people think for a lot of different reasons that gold should be going up already. And I want to ask you, in terms of being a trader, you know, this is probably the most difficult part about trading. You have a theory, and you have to stick with it for longer than you might want, because things take a little while to play out.
Actually, the perfect example of this was when I started in the industry. I started writing my newsletter in 1998, and actually that was when my first book, which was called Stock Market Panic. Ironically, another book about how the market was a bubble and going to crash, and that you should be getting into gold and precious metals, which I thought at that time, when gold was 300, we're in a secular bear market, ending a secular bear market, about to enter a secular bull market. So we go look at what happened is that was late 1998. Gold was probably like just over $300 an ounce. and it bottomed in the mid 200s in both 99 and into 2001. So it essentially took 2.5 years from late 98 into about April of 2001 for gold to really start moving higher. So yeah, that's the problem when you're having these kind of bottoming, basing formations. Sometimes they can take 6 months, like the stock market did in 08, 09, and sometimes they can take years to unfold. And I think unfortunately, in the case of the gold market, it's taking years. And actually, this scenario right now really reminds me of the late 90s, early 2000s. Or again, we have a stock market bubble, and we have a multi-year bear market in the gold stocks. So back then, it was from about 96 to late 2000, just over 4 years. And this time, it's from 2011 to 2015, just over 4 years. So it's very similar where the market disconnected from the gold stocks, and probably the gold stocks will start trading inverse to the market or really outperforming probably starting later this year or even now or and the whatnot. And I should note, we have very, very nice basing formations in the gold stocks, in gold and precious metals. Silver has a really nice base in the $14 to $16 range that if it breaks over 16, I think it would really, really move. And by the way, this is something we're going to talk about too. When this gets going to the upside, and one reason I don't think we have seen the top in gold is, as you know, even though it seems very unlikely right now that gold will revisit 1900 an ounce, is the way the gold equities traded. If you go look at the way that these gold equities traded in times like 1997, 1987, or even 2007, 2008, if you go look at them, they traded much more bullish than they traded, or I guess parabolic, than they traded in the last top. And I'll get into that in a second.
2 points that we discussed yesterday, and they tie into each other. We were discussing the fact that in 2001 to 2007, that was an extreme bull market because you had that length and the multiplier effect, especially when you're investing in juniors. You can make a ton of money, whereas the move was much more violent coming out of 2008 crash. It was short, and so your ability, especially if you're investing in warrants, was not that strong to make that much money over that time frame. The other thing, which you just touched on, is the prices of these juniors. We didn't see $10, $20 juniors across the board. And you were saying that back in 1996, especially with the Briac scandal, you were seeing these junior companies on the exchange trading for $10, $20 per share. So that indicates to us that the high is probably not in. Last piece before I turn the microphone back over to you is, you know, the bear market's been going on for 4 years, and I need to look back at history, but I don't think that a bull market in the gold stocks has ever been shorter than the preceding bear market. So I'll turn the microphone back over to you.
Yeah, because about the longest two bear markets I can think of, just to get to that point before I talk about like a parabolic top would look like, were the 80 to 82 bust when the bubble burst, and that was about 2.5 years. And then that 96 to 2000, 2001 level, which was, about 4 years. After the 87 bust, when the gold stocks did bust and the juniors did bust with the stock market crash, it's really difficult because by some indications, the market started higher in 1990 after a 3-year bull market, and by some indications, it didn't start getting hot till 93. But for the most part, the juniors just bottomed in 90, and just there wasn't very much going on in the early 90s, but they bottomed and started slowly moving higher. But in terms of that, I remember I was a big fan of Bob Bishop. I just started. I was actually in my late teens, but I was trading a small amount of money, which I'd saved. And I had stocks like Arizona Star, which was taken over, go from $1 to $6, $7. Actually went as high as 15 at some point. I sold it, I think, around 6 at the time. I had a stock called Corriente, which was a copper deposit, go from $4 to $20, and then that would crash back to $1. So these were the things, and I remember looking at the stock charts and during Briac, during Diamond Fields, during all these bubble names, or those are Diamond Fields was legitimate, but during that time, and there were all kinds of juniors trading at $5, $10, $15, $20. There was some juniors that, especially when they were in Indonesia because of Bre-X, they would just have grab samples and trade at, in the teens, forget about in the dollar range. And we never really saw that. We saw a bit of that in 2007, 2008. We had stocks like Northern Dynasty like go into the low double digits. But really in the last move, we never really saw that. And I think that's still why we're ultimately, even though everyone can be so negative in the precious metals now, we will still see one more big bubble move where you're going to see those kind of moves in these stocks. And everyone hates junior mining so much right now. It's probably a good time to start looking at some of these companies, the ones that will survive. But I think really, really, we're going to see that. We're going to see these double-digit moves. And by the way, that's one simple indicator I use. When I start seeing too many junior stocks, say, trading north of $1, I think that's just a sign, and especially if they're $10 or $15, that the market's too frothy and about to stop. And by the way, we saw that recently in the Canadian biotech sector. Again, these are penny stocks, and there's literally dozens of Canadian biotech companies trading at 5, 10, 100. One's even that I'm short right now was up to over $100, and these stocks were all penny stocks or low single-digit stocks just 3 years ago. So that's usually just a simple sign, psychological indicator you can use, is to see how many stocks are trading at these excessive high valuations.
So, David, coming back to where we started the interview, things are a little bit crazy right now. The valuations in the Dow are high. The valuations in the gold stocks that we discuss all the time, extremely low. And, of course, the saying that things can get crazier means it's hard to predict exact timing. But I'm going to ask you the difficult question here. What are you doing right now? And what do you think about the timing? I mean, when do you think that these gold stocks are going to turn? And when do you think that the Dow is going to turn down?
I think the stock market's a little tougher because we don't know how the market will act, even if it is a bear market. Like, you could still see another, even though we've seen a surge to over 2,000, you could still see another surge at 2050 in the S&P, which would be, a 65% retracement, which is perfectly normal in a bear market. In 2000, when the market began to fall in the fall, what happened is it really just grinded lower all the way until March of 2001, and then finally kind of got oversold and had a good bear market rally then. So we could see a grind lower. We could see a crash situation where the market peaks in the next week or two and then again goes lower into October, November. So with the stock market, I got to say, the timing, I don't know. I've thought all along we would see another leg lower this fall, and I've kind of positioned myself for that. But I'm also willing to be very flexible if that doesn't happen and kind of change. With the gold and gold stocks, due to the length and time of this bear market, I really think it's got to start the bottoming formation by the end of this year. Maybe the last flush out due to tax loss selling in, the October-November period. But I would think where the HUI to gold ratio, where it is, even lower than it was at the 2000 low, and how beat up these stocks are, that we really can see a final low in gold, no matter what the market does. And here's kind of the scenarios. The two scenarios would be like this. Let's say this is just a correction in the stock market. Well, if it's just a correction, probably China would stabilize, all these emerging markets would stabilize, demand from commodities will start again, and that would really help gold and precious metals, even if the Fed is raising rates. If it's a bear market that starts in the next 3, 6, 12 months, which I think is much more likely because I think this emerging market stuff has a chance to turn into a crisis again. What would happen then is the Fed, the U.S. markets would dump 20, 25, 30, 35%, whatever it be, maybe even more. And then the Fed would fight it with more QE. And I think this time the QE, the mentality would be they really don't know what they're doing, and they caused this last crisis. So we want to be in PMs, we want to be in commodities, we want to be in stuff that they cannot deflate the value of by money printing. They cannot print gold or silver or copper or whatever. So those are my two scenarios, that either we're going to see a turnaround in the EMs and then you'll have more demand for commodities, which should help, or you're going to see some kind of crisis and then the Fed come back with QE4 and gold can just take off at that point. And I think right now I actually bought some long-term call options in a couple of intermediate size producers. And I think, or that way, or just buying the producers themselves is kind of what you want to do now between now and the end of the year. And remember, I've been on the show not that bullish on the PMs, recently saying that the market needed a bust for the Fed to act, for the PMs to go higher. But now that we finally have seen a correction lower, I think we're getting closer to the point where the PMs are going to be a very, very good, strong buy.
The other thing that you were saying to me yesterday is, listen, even if the precious metals are potentially going to get cheaper, they are so cheap right now that if you're not already invested, it makes sense to take a sizable bite and see how things play out moving forward. David, I want to ask you if there's anything else at this point that you want to share with our listeners or talk about.
There's actually two more things in terms of the stock market. I think the two key things that people should be watching now that maybe they're not is actually two ends of the debt market. And one would be the high yield energy, which now is 15% of the U.S. junk bond market. And a lot of these loans are reset in October. And a lot of these companies are going to ask for money because they're just producing right now to try to cover debt. And a lot of banks actually doubled down this spring, hoping that oil would go back to 70 by the end of the year, which obviously is not occurring. So I think that you could see some major defaults in the energy markets, and maybe even a large foreign producer, maybe like Petrobras, will run into some debt problems here. And that could trigger debt defaults. And then one of the big offshoots and bubbles of QE was not just the stock market going up, not just a bubble in biotech stocks or something like that, which is much more serious, was that there was a bubble in emerging market debt that was created. And by the way, in my new book, I have chapters on each of these debt bubbles, the energy bubble and the emerging market bubble. And if we look at the emerging market bubble, what we see is countries like Turkey, Brazil, and many others issued a lot of their debt in U.S. dollars because the idea was, well, the Fed is printing. They're going to keep the dollar low. And then when they keep the dollar low, let's go to Brazil. Let's go to a top-tier company there like a Petrobras or like, one of the telecom companies. And we'll get bonds at 6, 7, 8%. Even we'll get bonds at 6, 7, 8% from the Brazilian local, municipal, state, and federal governments. And that's way better than getting the U.S. Dollar bonds at 2%, and the real is going to stay strong because the Fed is keeping the dollar weak. And that's all being unwound. And there was literally trillions of that debt issued. Actually, way more of that debt issued than ever issued in subprime. So if these two things kind of blow up, you get defaults in the oil patch, and you get defaults from EMs. That could definitely be the trigger for the next crisis. And I think that is actually closer to happening than what people really believe.
All right, David, thanks so much for coming on again. And for all of our listeners, it's David Skarica with addictedtoprofits.net. One final reminder that we're doing the book giveaway for one more week with Jordan Roy Burns' new book, The Coming Return of Gold's Secular Bull Market. Thanks for listening.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen? Or are you too stupid?